Welcome to our module on plant assets. In this module, we'll have an introduction to the characteristics of plant assets and the three examples of plant assets. First, the properties of plant assets. A plant asset represents a stream of future services. It's very similar to long-term prepaid expenses. It's paying for something in the current period that we intend to use over an extended period of time. It represents advance purchase for a future service, and it will always be classified as non-current because the plant asset will be used for more than 1 year or one operating cycle. There are three different types of plant assets that we'll discuss. They are tangible, intangible, and natural resources. We'll start with tangible. Tangible plant assets are those that have physical substance. They include property, plant, equipment, buildings, etc. Plant assets that are subject to depreciation would be everything except for land. Land is the only plant asset that's not subject to depreciation, and that's because land has an unlimited useful life. Intangible assets are non-current. They have no physical characteristics. By definition, if an asset is not classified as non-current, in other words, if the asset is classified as current, it is not considered an intangible asset. Examples of intangible assets include patents, trademarks, copyrights, franchises, and goodwill. Natural resources are generally sites acquired for extracting resources that would be considered natural resources, not land. For example, oil wells, mineral mines, forests to extract timber, those are all considered natural resources. As we extract the natural resource, we would convert the natural resource to inventory. So, for example, as we extract diamonds from a diamond mine, the diamonds become our inventory. The accountable events in the lives of plant assets include acquisition, depreciation, which is the allocation of the acquisition cost to expense over the asset's useful life, and the sale or disposal of the asset. At acquisition, costs include all expenditures that are reasonable and necessary for getting the asset ready for its intended use. This includes transportation costs to get the asset to us, sales taxes, delivery cost, installation cost, etc. Always remember that the cost of a plant asset includes all costs that are reasonable and necessary for getting the asset to the desired location and ready for the intended use. There are some special considerations. For example, land improvements are depreciable, and they're accounted for separately from the land. For example, if we put in driveways, fences, or parking lots, those are separately identifiable assets and not considered part of the cost of the land. Because these assets have a finite life, they are depreciated. Again, land is the only plant asset that is not depreciated, but land improvements are depreciated. Another consideration is when multiple assets are purchased for a lump sum price. So if we buy a house and a building on a parcel of land, we have to allocate the cost of the entire purchase price to the individual assets. And we'll take a look at an example. So we have a total purchase of $2 million in fair value per an appraisal. The land is $500,000 fair value, the land improvements $100,000, the building $600,000, and the equipment that we're purchasing $800,000. So The land represents 25% of the total fair value of the asset based on the appraisal. The land improvements represent 5%, the building 30%, and the equipment 40%. If our purchase price was $1 million, that would suggest we got a pretty good deal relative to fair market value, but we need to record the assets on our books at the purchase price, not the fair value per the appraisal. So we will allocate 25% of the purchase price to the cost of the land, 5% of the purchase price to the cost of the land improvements, 30% to the building, and then 40% to the equipment. So we're allocating the total cost of the acquisition to the individual parts. So we have 4 identifiable assets on our balance sheet. The journal entry to record this acquisition would be a debit to each of the 4 assets for the allocated cost and a credit to cash for $1 million, representing the total purchase price. We only use the fair values per the appraisal to allocate the purchase price to the individual assets. After we purchase assets, there are 2 different types of expenditures that we can have on these plant assets: capital expenditures and revenue expenditures. Capital expenditures represent expenditures that benefit more than one period. Revenue expenditures represent expenditures that only benefit the current period. For example, a capital expenditure is an expenditure for the purchase or expansion of a plant asset. It's recorded to an asset account by increasing the account. Because if we purchase or expand a plant asset, that would be benefiting more than one accounting period, so the asset account is debited or increased. Capitalized means to charge the expenditure to an asset account rather than an expense account. Any material expenditure that will benefit several accounting periods is considered a capital expenditure. A revenue expenditure is one that benefits only the current accounting period. Ordinary repairs, maintenance, fuel, and other items that are necessary for ownership and use of the plant asset and equipment are considered revenue expenditures. Revenue expenditures are expensed in the period in which they are incurred and therefore are matched against the revenue that would be generated from that accounting period. By following the revenue expenditure appropriately, we're achieving the matching principle. In review, there are 3 types of plant assets: tangible, intangible, and natural resources. Tangible assets are distinguished by having physical substance and benefiting multiple accounting periods. Intangible assets lack physical substance but also benefit multiple accounting periods. Natural resources are those sites that we acquire to extract natural resources. The cost of a plant asset include all reasonable and necessary expenditures. Capital expenditures benefit multiple accounting periods and are added to an asset account. Revenue expenditures benefit only one accounting period and are expensed as incurred. That concludes our module on introduction of plant assets. We'll continue to look at other issues related to plant assets in the next modules.